Hello everybody, my name is Mark. Welcome to another one of my investing videos, and in this video, how much money do you really need to start buying and selling stock options? And let's go ahead and take a look at what I did today. Now first of all, let me go back. Okay, this is my margin account. I only have $2,400 in there, $2,430.69. Okay, not exactly a lot of money, but let's look at what I did today. I did this just today. So today is September the 10th, 2018. I bought to open one call right there at the price of 7.7. So I had to fork over all of $777.71. Now buying one call option is the equivalent to buying 100 shares of that stock, and this is on Twitter. So if I would have bought 100 shares of Twitter, let's take a look at how much it would have cost me. So Twitter right now is trading at $30.55, so it would have cost me over $3,000 to buy 100 shares of Twitter. And maybe that's not a lot of money either, but let me go back here. $777.71 is not a lot of money. And now, between now and let's look at the expiration, January 17th, 2020, $30. So anytime between now and January 17th of 2020, I can exercise my right to buy Twitter at $30 a share. Now that cost me $777, so the break-even point would be if Twitter went up $7.77 and 0.71, so it'd have to go up almost $8. But if it went up that much, then I would be playing with the house's money. That's my break-even point. So Twitter would have to go up from let's take a look here, from $30.55 plus $7.77, so $38.20. If it went up that much between now and 2020, I have all the way from now until 2020 to make money on that call option. Then I can sell it back to the market right now, and already you see it's gone up a little. The bid here, let's take a look, it's already at $7.80, so I've already made $5. Now $5 doesn't sound like a lot of money, but remember, I'm making that $5 on a $777 investment, so that is a 0.13% return in just one day, right? So the math really works out very well. Now the worst thing that could possibly happen to me is that I don't make any money and I lose all $777. Okay, that's the worst thing that could happen to me. Let me go back to my account, and then I lose $777 of my $2,430. So again, you don't need a lot of money to start buying and selling stock options. Now if I wanted to, ladies and gentlemen, let me go to the option chain here and let me show you what I could have done. Okay, I could have bought a $30 call option that expires at the end of the week, and it would have cost me $95, right? Actually, it would have cost me the money that I sold it for. So if I go back to my transactions here, if instead of buying this long term, if I had not have done that and I would have just bought this call option, $30.50, and it's a weekly, for $58, well, let's take a look at what would have happened had I would have done that instead. I would have spent $58 and it would have gone up to $65 as the bid, 67. So I would have made a whopping $8, right? Doesn't even cover the cost of my commission. So if I were to buy a weekly contract like that, then I would want Twitter to go up to $31 or $32. Then my $58 could turn into $100 or $200, and so already you can see the implications. Okay, so you don't need a lot of money to start buying and selling stock options. Every single strategy that you can think of known to man is based on one fundamental idea, and that is the buying of selling options. Every option strategy is based on that idea, whether it's a credit spreads or debit spreads or iron condors or selling covered calls, selling cash secure puts, doing butterflies, doing the option caller strategy, which is one of my favorite strategies. You pick whatever option strategy you come up with. They're all based on the buying and selling of stock options. And what I did, again, let me go back to my transactions. What I did here is known as a calendar call spread. And the reason why it's called calendar is because I bought a long-term call that doesn't expire till January 2020, and then I sold a short-term call which expires at the end of the week. So I spend $777.71, that counts as a debit, and then I sell this option and I take in $50.29. So at the end of the week I collect that money. And then what are the potential risks of this particular strategy? Well, there's three possible things that could happen, right? Twitter could go up, Twitter could go down, or Twitter could just stay right where it's at. Now, first of all, if Twitter goes up, let's say at the end of the week Twitter goes up to $32, okay, what's going to happen? The value of my call option will go up, but so will this. And this call I'm long on, this call I'm short on. So this call I will make money, this call I will lose money. So the strategy or the plan that I have, and you should always have a plan in place to manage your position, get whatever the stock decides to do. My plan is a strategy known as rolling up. Now, how do you roll up, and what do I mean by rolling up? Let me go to the option chain, and let me go on Twitter, and let me go to the option chain. Now, let's say that I did all this last week, okay, and I bought a call for whatever price and I sold a weekly call, and let's say that today was Friday and I wanted to roll up these options. Okay, so let's say that I sold a call down here at 30. Let's say that Twitter was at 29 last week and it went up to 30 and all the way where it's at 30 and 54. So if I did nothing, then what's going to happen is that my shares of Twitter will be exercised, and I will be obligated to sell my shares to whoever the buyer of this contract is. So in order to avoid that, I do what is rolling up. So what I would do is I would buy back this $30 call for the price. So I click on the bid right here, right? I go to buy to open like this, put in the contract, put in the price, click in review order, and then I put place order, which I'm not going to do. Okay, but that's what I do, and I buy that contract back. Now to roll it up, okay, after I did that, I buy that 30 call back, and then I go out to a further date and I pick a higher strike price. So I could go pick 30.5 or 31 or 32 or as high as I want to go, and I have to find a price that is more than what I spent to buy this one back. So I'd have to find something higher than $95, or the bid 95 and 97. So if let's say I went out a month, it will be very easy for me to find a contract like that. Okay, look at this. Okay, I could go all the way up to 33 and break even, but what I would do is I go to 32, I'd buy this one back for 96, and then I'd collect 127. So I'd make more money on the premium, and I go up from 30 up to 32. So I also collect that extra $2 in intrinsic value, so that if Twitter went to $32, I would make this extra credit, right? I spend 95 and then I sell and I get 127, let's say 125, so I get like a little over $30 just in the premium. And then if Twitter went up to 32, I get that extra $2 a share. That's the strategy known as rolling up, and that's what I plan to do if let me go back to my transactions here, right here. So if Twitter goes above $30.50, let's say it goes to 31 or 32, that's exactly what I'm going to do. I'm going to roll up. I will find a call option that has a higher price than whatever I have to buy this for, and I will continue to make money from now until January 17th of 2020. And at some point, Twitter will go up high enough that I'll be able to find a contract, and the money that I get, the credit, will pay for the entire cost of this $777. And when that happens, then my investment is paid off, my profit's locked in, that money gets credited to my account, and then I will buy another call option contract, and I will replicate the process, and eventually, hopefully in a few months, I will have 5 calls or 10 calls, and I'll start making money hand over fist. That's my plan, that's my idea, and I'm sticking with it. And again, I don't need a lot of money to do this, do I? I only spent $771 to buy that call. I have all of $2,430 in my margin account, so you don't need a lot of money. You could probably start with as little as $1,000 and just go to town. So hopefully I give you some motivation and some encouragement to take the time, learn how to buy and sell call options, stock options contracts, calls and puts, and make a lot more money than you could ever make just buying stock. Just buying stock, you can make money, but compared to the money that you could make buying and selling calls and puts, no comparison, and you can do it with very little money. So thank you for watching this video. Hope to see you again in the next one.